Hey friends, Josh Yeager, Fiduciary Governance Oracle and Santa Barbara Dog Walker. I'm here on a walk on New Year's Day, considering the duties, responsibilities, and administration of a fiduciary, of a trustee, a successor trustee. And being the beginning of the year, I thought it might be a good idea to focus a little bit of attention on the trustee's duty to independently monitor the activity of agents to whom the trustee has delegated responsibility. So the application here for today's walk talk is when the trustee has delegated investment management responsibilities for a portion or all of the trust capital to an investment advisor for liquid marketable securities held by the trust. Of course, this isn't necessarily the only assets of the trust. Trustee might have house, collectibles, real estate, other things that they're responsible for. But today's talk and duty is about the duty to monitor agents. So within this duty, there's kind of two precursors to it. There's the duty to prudently select an agent. Why did you choose the friendly advisors at XYZ financial planning firm? Then there's the duty to prudently delegate to those advisors. I'm going to presume that you've already done work in that respect. It's kind of hard to have a monitoring process if you haven't already defined what the outcome is that the trustee is supposed to be managing towards, or the delegatee is to manage towards. Check this out. Cool little river here. Yeah, that's cool. Okay. So, duty to monitor the agent. So, presuming we have delegated to the agent and said, friendly investment advisor, here's a portion of the trust capital. I have a targeted return and an expected risk outcome that I've defined for you. Now it's time to just check in and make sure that the annual review of that agent has been done. So that if any ne'er-do-well beneficiary comes and says, trustee, you shouldn't have delegated to that agent. I expected that the capital markets would always go up and that the trust assets would always have positive return and even above that excess return, alpha. And that's really an unreasonable expectation, but they're going to make that complaint, or sometimes they make that complaint. And we've got to have a nice record in our compliance library that the trustee has taken steps to monitor the agent's activities. So what's that involve? Well, number one, you've got a target return for the agent and a risk expectation. That in California is 16047B in the probate code. And all other states in the union have comparable language, but I can't cite the statute. So first thing you'd monitor is, okay, investment advisor, what was the actual return experienced by the trust? And compare that to the targeted return that I gave you to accomplish the trust purposes. And these investment advisors have really expensive software that can really easily produce that outcome. But they don't know that you're a trustee and that you need this data in your compliance library. So sometimes they don't provide it to you. So you just have to ask, and I assure you from past experience that they're going to be happy to comply. Answering the question, what is the return? Now, what period do we ask that for? We shouldn't ask what was the return last quarter, or even what was the return last year. It should be, for a long-term trust, what was the return since the inception when I gave you the assets? Because, of course, there are going to be periods where the investment performance is fantastic, far above the expected return or the targeted return. And there will be periods where it's below. Hey, Dodger, hold on. I'm going to take you off leash. And so it's a good practice to get the return since inception and compare that to the targeted return. Second question, what's the risk that I experienced, Mr. Investment Advisor? Again, they have this data available. It's pretty easy to produce it with the expensive software that they have. It's pretty rare, actually, for investment advisors to provide risk experience. That would normally be used. Standard deviation is the kind of industry standard for defining what the risk is of the portfolio. So again, hey, advisor, when I hired you, I asked for a long-term 6% targeted rate of return, and we said that we would expect a 11% standard deviation, let's say. Now, the trustee isn't supposed to know how to calculate these things. They would rely on the investment advisor at the inception of the relationship to come up with those expectations. But now it's time to measure against those expectations. So, trustee asks the advisor, they print out the report. Other things that should be considered during this annual review is just a reaffirmation of the fees that the advisor has agreed to be paid to do this work. And that needs to be documented, and the trustee just says, hey, could you just remind me of what we originally said you would be paid, and then confirm that you actually got paid that during the last year. Another factor that would be considered is, well, we've got this return outcome, which was some return outcome with some risk experience. How did that risk and return compare to a comparable portfolio? So that would be a benchmark or an index that would be reasonably compared. Now, you have to be careful about which index you use. You can't have a portfolio with 60% stocks in it and compare that portfolio's performance to the S&P 500. That would be an unfair comparison. So good practice is to ask the investment advisor, hey, come up with some blended benchmark with similar asset classes that you've defined for me in the portfolio. And let me know how the actual portfolio did against the benchmark. Another practice that I like to use is pick some well-diversified mutual fund to do something like a peer group review. The Vanguard Life Strategy Fund with 60% stock and 40% bonds, for example. The return is readily available for all investment advisors. It's published. And the investment advisor can quickly run the actual portfolio's return and risk characteristics to the performance of a blended benchmark that they come up with and a product that has a similar asset allocation. All of that stuff goes into a file, preferably with the investment advisor's heading or letterhead. And then the trustee can say, look, I did my job. I had this duty to independently monitor the advisor. I checked the actual performance of the trust against the performance of a benchmark and of a product with similar risk and return characteristics. Looks like everything's in line. One thing to note, you didn't hire the investment advisor to exceed the return of a benchmark. You hired the investment advisor to accomplish a long-term return objective. So kind of the key there is don't get bent out of shape if the investment advisor's performance is a little bit under that of the index or of a mutual fund, a diversified near low-cost or no-cost mutual fund, because the investment advisor's got to get paid, presuming they're adding some value for you on doing some financial planning and other matters, producing these reports for you, CYA for the trustee. So the objective is not whether the investment advisor exceeded the benchmark that is being used to compare them or the product that they're being compared against. It's really to test, are they in the kind of right zip code? Did we get about a similar return as we would have expected from a non-advisory relationship? And did we accept the same amount of risk to get that return? So all of that documentation would go into the file. Investment advisors, I've found, are really quick to help out in this case. You just have to explain to them, look, I'm not a rich doctor with a bunch of money in my retirement account. I'm a trustee. I got these duties and responsibilities to a third party. I heard this guy on this video say I need to create this compliance library, and here's one of the things I needed to create. So at the beginning of the year, now's a good time to go through that exercise, get that documentation in the file folder, tuck it away, and hope that nobody ever asks for it. Because if somebody's asking for it, that means they're ticked off at you for doing something. But it's good practice to go through the drill, go through the discipline of asking these questions and making sure they're answered so that you can demonstrate that you acted prudently and in good faith and consistent with your duties of care, and in this case, that duty to independently monitor. Hope that's helpful for you. See ya down the road. Ciao.